Welcome to another Pendal podcast. Today I'm joined by Tim Hext, Head of Government Bond Strategies at Pendal. Tim, we've got a Reserve Bank board meeting coming up.
Yep.
What are the key economic indicators you think the board, its members, the Reserve Bank are watching most closely at the moment?
Well, front and centre, as always, is inflation. And on the inflation scorecard, since they last met, it's a mixed bag. Obviously, the Middle East flare-ups continue to put a little bit of pressure, but fuel prices are generally reasonably well behaved. I think everyone can experience that in their daily lives. We did see petrol prices get as low as $1.50. The excise has come back on, half at the end of June and half likely at the end of July. And so that's going to see petrol prices sort of settle down around about the 180 mark, which in and of itself is not particularly inflationary or deflationary. The Reserve Bank's forecasts look about right for now. And so the way I would summarise it is inflation in a outright sense is sort of uncomfortably high, but not going higher. And, you know, on forward measures, it does look like it's going to moderate into 2027. And by moderate, I mean closer to 3% from where we are now, around 3.5%. None of that lends itself anytime soon to rate cuts, but it does take the pressure off the RBA to hike rates again.
If the bank does hike rates, because there's still that chance if they're above that 2 to 3% range for a while, what does that mean for investors, local investors, particularly around how they position their portfolio?
Well, obviously, I mean, I look after bonds, which are term interest rates. And, I think you had Steve on your podcast who looks after our cash. So clearly, if they went from 435 to 460, that impacts the cash rate. And, of course, that's an alternative for a lot of people. So it puts pressure on other instruments. But I do think it's important to remember cash rates are restrictive. They are above the average and longer-term average. And there's a number of reasons for that. Obviously, the one which everyone's aware of is inflation and the Middle East developments in things like oil markets. And there's also this continuing legacy, even now, 6 years on from what happened during COVID. But the other story which has been happening is what's happening beyond inflation, and that's something we call real interest rates, or the part of interest rates which isn't made up of inflation. Yeah. So when you look at a return on a bond or even a cash rate, there's part of it which is trying to compensate investors for prices or inflation. Mm-hmm. And then there's an extra return on top. And at various points in the cycle, that can be anywhere from negative or flat, as we saw before COVID, all the way up to where we are now, around about 2.5%. So it's pretty generous for investors. You can put your money in even a safe investment like cash or government bond and get a very decent return above inflation, which is, of course, what everyone's liability effectively is, trying to keep pace with their spending power. And so there's a nice term premium at the moment in both bond markets and in those markets as well. So, you can get a 2.5% return above inflation locked in for the next 10 years. And the reason we're here, the reason we have gone from 0 back up to 2.5 is because of the investment boom we're currently seeing. Australia's had two great investment booms this century. The first one was the mining boom, and that was huge. In fact, in terms of scale, it's bigger than the current IT boom we're seeing now. But in the US, the current IT boom, particularly around, the well-known story of data centers and AI, is bigger than anything they've had. And of course, that puts pressure on capital. What it does, it also, the promise of high returns means people borrowing the money are happy to pay more. So you start to get this term premium increase and real interest rates go up. It's a great spot for investors. Not so good, though, if you're borrowing money, which is the flip side of it.
So, I sort of, we're probably stretching beyond government bonds here, but that's sort of the trade-off around credit quality and duration and things like that. How do you think about that?
Okay, so I think there's two things to keep in mind. In the near term, we're going to continue to see a little bit of pressure. The infrastructure boom we're currently seeing is not a 1-year boom. It is a 3 to 5 year boom in terms of data centers being built, in terms of, the actual physical building of a data center is only about 20% of the cost. 80% is obviously filling it up with the necessary IT equipment. And we're only, we're reasonably early on in that process still. But when you look beyond that, there's two things investors need to keep in mind, and this is more medium to longer term. Firstly, the things which caused us to have much lower interest rates as recently as 6 or 7 years ago are still percolating away in the background. Things like demographics, that's a key one. That's not changing. Demographics don't change anytime soon. So that's going to put ultimately downward pressure on real interest rates. And the second thing is the unknown other side of the AI revolution, if you like, is what it will mean for things like labour markets and what it will mean in the longer term for the economy. And, I'm leaving aside the idea of the return you're going to get on your investment. I'll leave that to the equity guys to worry about that, given the huge amounts being spent. And there's obviously a question mark over that. But as a bond investor, I'm thinking, what does it mean for term interest rates, which will remain under pressure near term? Now, when I say under pressure, I don't think they're going to go much higher, but it does limit their ability to have a strong rally. But, and here's the but, is we just don't know when things will turn.
Yeah.
And it could be next year, it could be longer than that. But the point is, when you got the returns currently available, it does pay investors, particularly older investors, to look at locking in some of these very attractive returns we're currently seeing. It's a great environment, as I said, particularly if you're a person approaching or early on in retirement.
Okay, so I think you've just answered this, but there are definitely opportunities in government bonds and fixed income markets at the moment, and depending on where you are in your life cycle. But, kind of if you wanted to pick out one or two or three big opportunities in fixed income, where would they be?
Okay, so the first opportunity is quite simply a 10-year government bond is currently paying 5%. If you buy state government debt, that's paying you above 5.5%. And if you buy corporate debt or the like, and there's some still good quality investment grade corporate names, they're paying up from 6 to 7%, right? Now you compare that to a cash rate of 4.35, maybe compare it to a term deposit rate. If you're lucky, getting closer to 5%, there's a very decent pickup you're seeing. And what you have, because you are locking in those rates, you in a sense also buying insurance against the other side of your portfolio, the growth side, which at the moment seems to be doing very well. Everyone's getting 10% returns in their superannuation, etc. You're buying insurance that can flip. And how does it flip? Well, things are moving so fast at the moment that the question you still have to keep an eye, very close eye on, is labour markets, because this investment boom ultimately, as much as people try to pretend otherwise, is about increasing efficiencies for business. And efficiencies is kind of code for, can we let go of staff? And, everyone's aware of that. Everyone's kind of unsure about it, but things can move quickly. And if you haven't locked in interest rates, and we start to see that turn happen a lot quicker, your cash rate returns are going to plummet back down, potentially, by the end of this decade, back down towards the 1%, 2%, 3%. And if you haven't locked in rates up here now, I think there'll be a lot of regret around that. So, if you buy a government 10-year bond at 5% today, can I guarantee you it's going to be lower than that, not higher, over the next 6 to 12 months? I can't, but I do think there is value. But if you're looking at it on a slightly longer term basis, and again, I want to emphasize, particularly if you're near retirement or just gone into retirement, because the one thing people forget is your biggest exposure is inflation. Like everyone likes to talk about 10% returns. Clearly, that is not sustainable over the longer term. But if you have an environment where inflation is ticking up and you're not protected against it, as we saw in 2022, that can be very painful.
Tim, thanks for talking to us today.
Thank you, Sean.
You've been listening to another podcast from Pendal. I'm Sean Aylmer.